Geopolitical concerns in the Middle East have impacted several markets, including equities and including the oil markets. The real question right at this point appears to be, is President Trump going to act, or are we looking at additional negotiations? I'm going to talk about that with my good friend and colleague, Professor Mark Guthner, today during office hours on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Interest, and welcome to Office Hours with Professor Mark Guthner. How are you, Mark? Good to see you.
Good to see you, Mark. I'm Mike. I'm doing quite well. It's nice. Every day is in the summer is a great day as far as I'm concerned. Yeah.
Looks like your home office is stacking up with stuff for your son.
Yeah,
I
I
see
got
boxes, strollers, things like that behind you.
Yeah, he's kind of takes over with all his stuff. Yeah, we're gonna after the show here, we're gonna go to the park. He just woke up. I'm gonna have to step out for a minute and put him in the other room. Say hi say hi to the crowd, would you?
Hey there, buddy.
Say hi to the
he
crowd.
He can't hear us. I'll let you take care of that. In the meantime, I also happen to see in the comment section here that Monday Morning Quarterback is joining us, apparently from Greenland airspace in an Airbus 380, Doha to SFO. And apparently it's an extra hour and a half to dodge the conflict in Iran. And so what had me thinking about this is that, when we talked about it on the earlier live stream, the real question was, would the administration step in, probably largely at Benjamin Netanyahu's behest, and strike the nuclear facility at, I think it's pronounced, I don't know, is it pronounced Fordo or Fordow? This is the fortified location where the centrifuges that are developing their where they are enriching uranium is located. This is, and I don't actually have a picture of it handy, but we can probably look one up. But as I recollect where the map is, I believe it is just south, maybe slightly southeast of Tehran. Now, supposedly, this facility is located at least 300 feet below the surface of the ground. That's what has been reported. I don't know how good Israeli intelligence on this location's fortifications and, whether they have schematics of the facility, but the suggestion was that only the United States could attack this location and potentially disrupt or destroy Iran's uranium enrichment capabilities, because we could use our bunker buster bombs, which are known as, we have a couple different bunker buster bombs, but the one that everybody is alluding to is the GBU-57. This is a 30,000 pound bomb. 25,000 of those 30,000 pounds are the steel structure. It is supposedly dropped from an altitude of 40,000 feet. Because of its weight, we only have one bomber that is configured to carry it. That is the B-2 stealth bomber. It can apparently carry two of them. And this thing can apparently reach, well, nobody really knows the exact specifications. And Mark, I know you worked in the aerospace and defense industry, so I'll be curious to get your perspective on this as an engineer. But it occurred to me as I was contemplating this and having a little bit of a familiarity with much more minor ballistics, and it occurred to me that penetrating 300 feet of granite, which is apparently sort of the geology of that location, and I assume significantly reinforced concrete of some strength underneath it, and not knowing exactly where the targets are. Now, maybe they, like I said, they have better intelligence on this than than we would know. This is quite this would be quite a feat, wouldn't it, Mark? I don't think that. In fact, actually, I did a little bit of homework on this and was looking at the strength of granite, and I have a note on this. So the compressive strength of granite is 15 to 30,000 pounds per square inch, which is about 3 times the compressive strength of concrete. Now, I think we'd seen some suggestions that these things could go through, like as much as, and I'm assuming you would know because you worked for a defense contractor. When we talk about the specifications of these things, I'm assuming that this is sort of like best case from the contractor, right?
Yeah, I'm skeptical that if this facility is as far underground as you said, and fortified with as much reinforced concrete as it is, then I don't see how this works. I mean, think about, okay, that this bomb would be, I'm presuming, conventional weaponry, and not nuclear. And I don't even think a nuclear bomb could, damage something that far underground. Maybe I'm wrong. Maybe these things are infinitely stronger than I think, but whether or not it works or not, I certainly hope that we don't do it, or don't try to do it. I'm not one, at least at this stage of the game, that thinks it's a good idea for the U.S. to get involved, because that attracts China, that attracts Russia. Then this turns into something bigger that lasts for potentially years. So I try to find. I'm hoping diplomacy works here somehow. That's my hope.
Yeah, I mean, I think, first of all, I'm going to assume that most Americans are a little bit tired of forever wars. We don't seem to be able to avoid them, it seems. For most of my adult life,
Yeah.
the United States has been at war with somebody.
Yeah.
The Vietnam War was still going on when I was born.
Yeah, my brother was about to be drafted. He was his number was up, so they were on his sheet, and they were drawing names. And so he was a month or two away from being drafted. My brother's a couple of years older than me, so I missed it by a couple of years. And then the U.S. had, I don't know, what was it, 6 or 8 years of no war, so we had a peace dividend of some kind, and I was very happy that I didn't have to do that, even though, in some respects, you might think that I would want to be in the military. My grandfather was a brigadier general in the U.S. Army. I started as an enlisted guy and worked his way to the top. But
that must have involved a battlefield commission or something, I would imagine.
Yeah, he had 1 million badges for all these different operations that he was part of, various airbornes and whatnot. And he had a long career, and he fought directly in World War I, and in World War II, he was in charge of protecting the Denver Mint. Was his responsibility, not in the battlefield at that stage.
So you mentioned that it draws China in. I guess the reason why people should, if they're wondering, I know you mentioned something before we went live, which I will be interested to hear about. But one of the principal reasons that China would have an interest in all of this is that Iran is a large oil-producing state.
Yeah.
It is large geographically. It is significantly larger than Texas. Unlike some of the other distressed regions of the Middle East, there is a real history in Iran. I actually studied the history of the region when I was in college, largely because I was dating and madly in love with somebody who was taking the class. So I ended up signing up for it as well. But they export a lot of that oil to China, don't they?
Yeah. They do. They also, if things really get ugly, can really horse with the Straits of Hormuz. Now, I've been reading that they have been jamming GPS and causing little problems with the tankers going through that part of the world. So, things could get really ugly. One of the things that I mentioned in an article over at the Options Edge was think in terms of North American producers of oil. So we've talked about Apache here on this show before, but you might also want to consider Suncor, the big oil sands company in Canada. They also have some conventional, but they've got decades worth of reserves. They've basically built out their production facilities, and so it's just a matter of producing now. So higher prices just means a lot more profits for them. You might look at other companies in the U.S. That are in that space. Let's see if I have any.
Yeah, it's interesting.
Devon
Last
might be
week,
one as a Canadian company as well.
yeah, last week when I was on Fast Money, I mentioned that I thought because there wasn't an immediate or there wasn't, yeah, there was not any kind of a supply disruption that had resulted yet from Israel's attack on Iran. When was that last week that I was on the air? I don't think it was last week. But as this progresses and continues, the notion that there wouldn't be some disruption, gets more and more far-fetched, right?
Yeah.
Because eventually someone is likely to sabotage something. So whether it is a logistical disruption, like the Straits of Hormuz, as you just discussed, or whether it is a direct attack on an oil facility or production facilities. Iran is not going to engage in any kind of a scorched earth policy on their own oil producing fields the way Iraq did in Kuwait as they were fleeing back in the first Iraq War. I worry about what Israel could do. I understand why they're doing what they're doing, but that does not necessarily mean that everything that they
Good idea.
do is, yeah. I mean, it is a very difficult situation, right?
Yeah,
because I don't think there's anybody on the, well, there are probably some on the planet, but I don't think that there's too many in the Western world that want to see a nuclear proliferation, and particularly into the hands of a regime. Certainly for the people in the United States, this is a country where it's common for them to chant "Death to America."
Yeah.
This is not a place that we want to have nuclear weapons and to have the means to deliver them.
And Saudi Arabia has come out and said, SMB came out and said flat out years ago, we don't want a nuclear weapon, but if Iran gets one, we have no choice. We got
MBS, I think you mean. Easy to mix up the letters of the acronym, but yeah, you're talking about
MBS.
Mohammed bin Salman,
Yeah.
right? Yeah, the Crown Prince.
Yeah.
So yeah, it's interesting because there have been a couple instances in the past where their efforts to procure nuclear weapons have been stymied, and every single time that they have been, so for example, there was a sabotage where they destroyed some centrifuges that the country was importing many years ago.
Yeah.
Several years later, they had centrifuges actually functioning, and the computers that operated those centrifuges were infected with the Stuxnet virus, causing them to effectively self-destruct.
Yeah.
And people have used the fact that all of the prior warnings about them coming close to developing a weapon proved untrue, while ignoring the fact that certain steps were taken to make sure that they couldn't procure them, to use as an example that this is sort of a Chicken Little situation. But I would point out that it was independent investigators that found uranium that had been enriched to more than 83%
Wow.
at the facility. Yeah, at the facility in question. So that is not intelligence that is coming from the United States, and it's not intelligence that is coming from Israel. Iran said that was apparent. My understanding is that they described that as accidental. We didn't mean to enrich it that
Oops.
far. So, and by the way, 90% enrichment is what is required to be, what we call weapons grade. So once you get to 90% enrichment, so they were not far off, and this was some time ago. So it seems highly unlikely that that was indeed accidental, and I think that there is evidence that they have, made steps forward and then been knocked backwards. But each time they've been knocked backwards, they have redoubled their efforts, both in terms of technology and other things. So their prior efforts, which had been blown up, were above ground facilities, and that's why they have highly fortified ones now.
Yeah, underground.
And it stands to reason that, whether they're radical fundamentalists or not, we can't claim that they don't have intelligent people there, that they don't have people with engineering expertise, and that they would not have anticipated that someone would try to sabotage or attack the facility.
Right.
So if they were going to fortify it, I'm going to assume that they did so, recognizing some of the capabilities that were out there. These things are not entirely secret. And so my guess is that they have engineered a facility that is a very hard target indeed.
Yeah.
And it strikes me that there is a risk if the United States acted and it was not successful. That might be worse than not acting at all, don't you think?
That could be like Jimmy Carter when he went in to try to get hostages, right? Complete military failure, crushed his presidency. One of, he had a bad economy to deal with, but that really put the icing on the cake for trashing his legacy as president. Hey, one of the things I want to look at, maybe let's kind of shift gears a little bit, see what the market thinks. I don't know could you pull up on Bloomberg OVX, which is the VIX equivalent for oil.
Mm-hmm.
So I wrote about this on the Options Edge a day or two ago, and if you go back far enough, you see that we're kind of trading at kind of historic highs. If you go back to 2007 or 8. Question is do we go even higher? I think if the situation heats up some more, then
yeah. So this is where we're at right now. We're at so that I think one of the challenges that one faces is that when you're looking at volatility in a situation like this, I can understand why it's elevated because everybody's on edge about what could happen.
right.
The real question is going to be an issue of timing. If there is a supply disruption, so the point I would make, if you think about the VIX index is always the rolling 30-day forward implied volatility.
Yeah,
And so if OVX is the same,
I believe it is.
my suggestion would be that if somebody's thinking about hedging, I would actually encourage them to go a little bit further out in time and lean long delta.
Yeah.
Right? Because the issue here is maybe buy some calls, for example, some longer dated calls in crude. Because if there is a supply disruption, it's going to take a little bit of time to work its way through the system, right? So the squeeze would not take place for most of, the very near-term delivery, right? Because, when we think about the logistics of crude as a product, there tends to be a lot of supply just within the supply chain.
Yeah.
So I'm talking about in the pipelines, in storage, in rail cars, and things like that.
Yes.
And so it's usually where you end up finding a little bit of a problem is you get squeezed at the long end. And what is interesting in commodities is that the volatility of a spot commodity price can get very, very high. I'll give you an example: natural gas. So natural gas, at the shoulder months, which is the tail end of the injection and the withdrawal season, can get extremely volatile. But in this particular case, I think you probably would want to extend a little bit further. So for anybody who's kind of looking at this saying, okay, well, and I'm going to guess that most people who are probably doing this are not necessarily trading, say, the WTI commodities. I'm going to start with that, though.
I would say before you look at a trade, pull up the term structure. The term structure is very backwardated.
In crude.
Yeah.
Yeah. So so I'm going to do two term structures to think about. So this is the term structure of volatility first.
That's what I was talking about.
And then, so in other words, and that's a sort of a conventional thing, right? So it is common, unlike for equities. So with equities, very often the volatility term structure is in contango. That is to say, and actually let me just illustrate this. Now that may not be the case now because we have all of this stuff going on, but basically it's generally the case that you have this upward slope.
Yeah.
See? Yeah. So this is the S&P, and you can compare that now to what we were just showing is the volatility term structure for crude. Now, when you're dealing with crude, there's two term structures to contemplate. The volatility term structure, which is what we're looking at right now. The other term structure to contemplate is the price of the futures themselves.
Right.
So that's the delivery of the physical. This also is in backwardation.
Yeah.
And this is the part where, now, this is probably not that surprising. So this is going to reflect the fact that in the long run, people suspect that oil demand is going to go down, and there is this sort of longer-term expectation that, sort of that peak oil hypothesis.
Well, even in this case, I would say that people think that whatever dust-up is going on in the Middle East is not likely to last into 2026. That's how I interpret this.
Right. So my thinking on this is that if you are inclined to play, if you're playing in the futures for a potential disruption taking place, my inclination would be to purchase longer dated calls on longer dated futures.
Yeah.
That would be, so if your expectation is this is going to conflagrate into something more significant and over a longer period of time, then you would want to take advantage of the fact that the longer dated oil futures are lower than spot.
Yeah.
And you would want to take advantage of the fact that the longer dated futures options are trading at a lower implied volatility than the near dated ones are.
Right.
Now, I don't want to suggest that that's not an appropriate situation under normal circumstances, and the reason is that it is not normal for long-dated futures to trade with a realized volatility. That is to say that their prices don't typically move around as much as nearer-dated ones do, and that is because spot oil and near-dated futures have to contend with real-time supply and demand imbalances.
Yeah.
Whereas the expectation is that everything is sort of converging to some sort of, long-term supply-demand balance. That's kind of a simplified way to think about why this dynamic exists. Nevertheless, I think that this does set up here for a potential play if you're thinking something could happen now, and the reason is simply because we've had such a big spike in the short-term futures already.
Right.
And what I'm saying is that there is a lot of oil within the supply chain. So if you're thinking, I think the July future, which actually the July future is going to actually is expiring today, come to think of it, pretty sure. Let me double check this. Yeah, this is actually the last day, I think, last trading day for the July future. So you'd actually have to look out to August in any case. Let Last trade is today. So this one's going to stop trading now. So it's actually the August future that you would be looking at, and the last trading day, just so that everybody is aware. Oops, sorry, wrong command line here. So the August future, which is the CLQ5. Last trade is Tuesday, July 22nd. And for those who trade options, by the way, on futures, they expire 3 days prior to the future. So that's going to actually fall on the preceding week.
There's something else I'd like to get your take on. If we could look at the SMILE on USO, because that's actually the data that I was looking at, the vol for USO. Take a look at the July SMILE. Throw a chart of that up.
Okay. July regular way?
Yeah. Mm-hmm. So what do you think of that?
You mean, why do I think it's this sort of shape?
Yeah.
I'm going to guess that the upper right side tail, certainly one of the dynamics is I probably expect that it's not priced all that tightly.
Okay.
And we're going to take a look at that right now.
I only looked at data going out to the 110 strike, and there was a nice big SMILE, and interestingly, the bottom of that SMILE was about a 70 strike. Now this was for, again, the SMILE on the volatility. So the SMILE on OVX.
Mm-hmm.
I'm sorry, is USO? No, it's USO. I take it back.
Yeah, USO. So let's just take a quick peek here. So part of that, some of those strikes that we were just looking at in that SMILE were really out of the money.
So we should just ignore.
So I'm just going to take a quick peek and see what. Yeah, see if you take a look up here.
Yeah.
So the 99s are almost 40 cents wide.
Oh, okay.
So that's 20% of the value of the option in terms of the bid-ask spread. So
so
that's going to get a little bit. That's very noisy. Mm-hmm. So I wouldn't take too much of that. I also wouldn't recommend, by the way, that people start speculating in those things either, for the reasons that we just articulated. I just don't. Do I think that crude is going to? Do I believe that the August crude future, regardless of what happens in the Middle East, do I see that doubling or something like that? Because I think some of the strikes we were seeing were, up, 100%, 170. Well, it's like 175, up 75%, we'll call it. I don't really see that. But those options are not going to be particularly liquid.
Yeah.
So I think speculating in that is probably a fool's errand.
Yeah, I was just trying to see if we could extract some information out of it, because the big SMILE would suggest to me that there's some people that want to bet that it gets worse, and so they're betting on the upside, and other people are betting that this will blow over quick, price of crude comes back down.
I would offer this though. Let me see if I can find it. I'm just going to look for a generic. I want to look for a generic skew in crude. It's not uncommon for commodities to have call skew, positive skewness.
Yeah.
So that's not going to be true for something like gold. The vol surface in gold is a lot like an equity, but the volatility surface in commodities, and this is more true the more easily the supply chain can be disrupted, for those things to exhibit considerable skew, sometimes call skew, often call skew, I should say, and a lot of kurtosis. So what is, if we think about it, what is, the most volatile sort of supply demand commodity price we could have? Electricity, right? Because electricity is not easy to store in real time.
No.
So, electricity has very volatile near-term pricing. So you can sort of think about what electricity prices should be in the long term, and people can actually enter into contracts. But in the short term, supply-demand imbalances can be quite sharp. Natural gas, not quite as much, but still considerable, right? So tail end of the shoulder months, when the depleted salt mines are being used to store natural gas, you start running out of room at the inn. You can suddenly see gas prices fall quite considerably. Even to the point where you're better off flaring your production than there's no other place to put it. And the same thing can happen during the withdrawal months when you don't have capacity keeping up with demand. But a little bit less common now because obviously we've had big increases in North American natural gas production, particularly in the United States. We used to get our excess demand satisfied by Canada before we really got into fracking, and then of course fracking totally changed the game. Okay, so let's take a look here. United Health, Steve Garcia, has seen heavy dark pool trading over the last week, $3 billion US dollars. To begin with, why do we allow dark pool trading? Is it needed or fair to avoid open market transactions? Seems like a sneaky way to trade. Okay, so I'd like to address that, and I'll let you opine on it afterwards, Mark, because I've used dark pools. And when I had access to them, and I've been on the buy side. So dark pools, is it a sneaky way to trade? It is a way to avoid others trading on your inside information. That's the way I think about it. So one of the first dark pools, LiquidNet, was developed by buy-side firms. So imagine that you're a fund manager at Fidelity, and there's a fund manager at Wellington, and you are buying 5 million shares of stock ABC, and Wellington is selling 5 million shares of ABC. Buy-side firms don't communicate directly with each other. They contact the sell side, investment banks. So you call a trader at Goldman Sachs. Now, here's the problem. Goldman Sachs can make a market in these securities. They may already know what Wellington's interest is, and they're going to reside in the middle, and they are going to collect commissions, and they might take some principal profits. You can't do both on the equity side by law, so you can charge commissions in some cases, or you can charge a markup in others. But the fact is that if a market participant like Goldman Sachs, if the dealers know that Fidelity is looking to buy 5 million shares, and Fidelity does not know where a ready seller is, this is an opportunity that they can profit off of.
Yeah.
So the first dark pool, the concept was, well, if there's an institutional buyer and there's an institutional seller, wouldn't it be better just for those two to meet independently and avoid all of these middlemen taking their pound of flesh along the way? That's a very rational thing for them to want to do. And the way some of these dark pools work, the buyers and sellers do not know whether there are other buyers and sellers, and they do not know who they are. They simply reflect their interest into the dark pool. So the users of the dark pool are exhibiting their trust in anonymity in the system. That is to say, I want to buy 5 million shares, and you are not going to tell anybody because others will try to profit on what I'm going to reveal to the dark pool, which is that I'm a buyer of 5 million shares. So you put your interest in, and the way the algorithms are supposed to work is that they only pair off interested buyers and sellers if they happen to exist. And they don't do it instantly even, so that they randomize a little bit of the process so that users of the system can't game it. The idea is that if I wanted to buy 5 million shares and I was wondering, is there a size seller out there? Let me go buy 100,000. I put 100,000 in and I get hit, bang, right away. Like, there is a seller. Okay. Let's try another 100. Bang, hit right away. Okay, all right. So there's somebody out there and they're pretty big. I don't know how big they are. Are they bigger than me or not? So maybe I decide that I'm going to reduce my bid and I'm going to wait until that seller comes to me. So I'm going to try to play a little bit of gamesmanship. Well, the dark pools recognized that there was the possibility that savvy traders would be able to recognize that you could still glean information just by how information percolated back to you if they acted in real time and if they acted in precise amounts. So they actually don't do that. So if I put in an interest to buy, maybe it goes off, maybe it doesn't, but maybe 20 minutes later it goes off. Now I don't know whether I just bought 100 or 250,000 shares or 500,000 or whatever I just bought. I don't know whether that interest came in after me or before. So I don't know whether I'm an active buyer and luckily for me a seller emerged, or whether there's been a seller lurking out there in the dark all of this time and I suddenly lifted them. So the whole objective of dark pools is to avoid others using the information from large institutional buyers and sellers of securities to profit at their expense. So is that sneaky? Well, that depends. If you're trying to profit from knowing where the big interest is, then I suppose you think it's sneaky that you don't get to find out. But if you're a shareholder in Fidelity's Magellan Fund or in one of Wellington's funds, this is information that all of those retail investors don't want to leak out because somebody else's profit comes at their expense. So now it should be said that once the first dark pools, which were only supposed to have buy-side firms involved, once they came along, investment banks became very concerned that this was taking them out of the equation.
Right.
So they developed some of their own dark pools, and they added little tweaks and little features, and our dark pool's better than that one for such and such a reason. So you should still give us your order, and we'll stick it into this super duper dark pool, which actually takes advantage of all the things of the one that you think, plus it does some other neat and tricky stuff. So there is now competing dark pools. There are program trading desks, and basically all you're dealing with is the constant battle and technology war between buyers and sellers of securities trying to get the best possible price for themselves and not allow their own interests and insights to leak out to the market so that other participants can take advantage of them. And this is just a battle that goes back and forth. And I think that whenever I find that there are technological innovations in trading that have been developed by people that feel like they've been taken advantage of, and others say, oh, that's very sneaky, the first ones to say it's sneaky are the ones that were taking advantage of the old way of doing things. And you've lived on both the buy and the sell side too. So what are your thoughts?
I think all that's right. There's more detail there than I was aware of. My thought was that dark pools started as a way of internalizing trades. So large firms like a First Boston has institutional clients all over the world. One wants to buy, one wants to sell. Well, why give the bid offer spread to somebody over at the NASDAQ? Why not capture that yourself? So you get a commission on both sides, and you get the bid offer spread as well. So I always thought that was one of the reasons why.
Yeah, I don't think so, because that's what sales traders do.
Yeah.
Right. So if you think about it, when I was at Cantor, when I was at Cantor Fitzgerald, for example, and if you think about Cantor Fitzgerald or Bass or Jeffries, especially in the secondary and tertiary names, so less liquid stocks, when you're not buying and selling Microsoft or Nvidia, you're buying and selling some off-the-run stock that nobody's ever heard of, and you need to transact it in size. Ivory, I think at the peak we were running about $5 billion. And as I recall, we had a minimum position size of 50 basis points. Right? So a minimum position size of 50 basis points on a $5 billion equity book is $25 million worth of stock. And if you have some stock that trades 25,000 shares a day, it costs, $15 a share. Well, you can't go into the screens and hope to buy that.
Yeah.
And in fact, actually, you probably can't even go into the dark pools.
Well, so the question I would have then...
So what? Well, here, let me explain. So the way this works is you contact your sales trader at Cantor. because you look up on the indications and the advertisements and you say, okay, what shops have been trading this? What sell-side firms have been advertising that they've been printing a lot of volume in this name? And then you call them, and you know that they've got 1,000 sales traders around the world that cover tens of thousands of institutional accounts. And you say, look, I'd like to buy this thing. How much do you want to buy? Well, again, you have to play games because you're trying to get your trade done, but you don't want the whole thing to leak. But they make a living trying to get you a good price because otherwise you'll never call them again. Yeah. So you'd say, you have to buy $25 million worth, but maybe you start off by saying, maybe can you go find me 100,000 shares? So that's $1.5 million on a $15 stock. And so what happens is there's literally, and I've, for years I sat, here's a microphone, but this is the way that would go. Someone would say, put me on the buy page, and the sales traders usually going to try to game it as well. So this is now being broadcast to sales traders all around the world.
Okay.
Put me on the buy page, 50 column ABC stock. And basically what happens is all of the sales traders go to work. So the sales traders at this point are now calling it. They know that they have accounts. They've seen the 13Fs, they know they hold it, or maybe they've traded it for themselves. Yeah. They call up the buy-side traders and say, hey, are you guys looking to do anything in ABC? And they'll probably do it that way at first. Sometimes they will advertise that they're a buyer. Sometimes they won't. Sometimes they'll just fish around and look for quotes. But that is the whole business. If you're ever wondering, what does a bank trader do, somebody like what I was doing, and what does a sales trader do? The sales traders are on the phones all day long dealing with buy-side accounts. Mm-hmm. Right. And finding out what they want to buy, what they want to sell, and then using the whole network of the firm to try to find liquidity as carefully as they can. Now, the firm's own traders, so in the options world, it doesn't really work like that because it's not like Fidelity's holding 1 million calls, and they're like, oh, well, we had these 1 million calls for the last couple of years. We want to get rid of them. Options expire. So that's a dealer-driven market. Yeah. So I was the dealer, which meant I made price, and that landed on my own book. But the sales traders, basically, I think we covered 5,000 accounts very closely, heavily. That means we traded with these guys a lot, all the time. So all of the big accounts. And that's how that worked. So the dark pools are essentially a way to pair off buy and sell interests to displace that kind of activity, or the big dealer markets like Goldman Sachs. You could also call Goldman Sachs and they say, we'll just sell you 250,000 shares of XYZ, ABC in this case, at 15. We'll make you a price on the whole thing, and then they'll just work to get back into it.
Okay, so let's, and you can to add some more fuzziness to it, price is a function of volume, right? The bigger you trade, you're going to get a different price. So how does that network abide by the national best bid and offer?
So, so the rules that cover this, so Reg NMS and things like that. So the way it works is, what is protected interest? What we call lit markets are protected. So that's the top of the book. For most people who are looking at the best bid and offer, you're only seeing the top of the book, NASDAQ level 1. Yeah. That is the consolidated, so it's all of the volume that is at the best bid and all of the volume that's at the best offer, which for any given stock is probably a relatively small amount. I don't have NASDAQ level 2 on this, but yeah, this is an excellent question, so that people can kind of understand how this works. All right, so right now, what do we have here? So, and actually, let me see. You know what? Let's go to something like Yahoo. Let me see what most people can get, like a Yahoo, probably like a Yahoo Finance or something like that. Yahoo Finance. I could probably come up with a dummy account, but what we do is we can just look up a ticker. Some of you might have level 2, and now you're going to begin to understand what that level 2 is actually all about, but let's see what we have here. So we have this is not showing me a bid and an offer. All right, so I'm just going to go over here to my interactive I'm not going to show my own screens because if I pulled this screen over, then it's going to show. I can't do that because actually it even has It actually even has my account number.
Yeah, don't
on that
don't
screen.
show the world that.
We're not going to do that. Anybody who has interactive brokers, you know what I'm talking about. Well, at least the way I have mine configured, all of my positions and my P&L are on the right-hand side, and my account number, because I have more than one, is in a drop-down right in the upper. And I'm not going to tool around with the risk that. So if I put in a stock, so I'll just put in Nike, and then I can see, for example, that it's 100 shares by 400 shares, 59.69 by 59, 59.68 now by 69, 100 by 500. So that means that the top of the book, there's 100 shares bid, 68 bid for 100 shares. Now it's 69 by 71, 100 by 4. So if you're going to print a big block of stock, you actually have to satisfy all of the lit bids and offers up to the price that you are going to print, and then you can print whatever you want.
Okay.
So basically, if I was going to trade 50,000 shares at 59.75, which is 5 cents through the existing offer, or through 69 now there's 100 shares offered there, I would have to, every lit offer, I would have to buy those with the buy side of the trade. So I have a customer to buy, so they're going to buy everything that's in the lit market, and then I can print everything thereafter at whatever price we've established. And that could be a principal trade, meaning I sell, or it could be paired off against another, another trader. So whether I'm doing that, so I was, as a trader, that's someone who has a Series 55. Series 55, if you're an upstairs trader, that simply means that you are allowed to print to the tape. Okay, so I can actually show you what some of these things actually mean too. So, for example, there are exemptions for printing through the price. Contingent trades are an example. Derivatively priced trades are an example. So if you can see my screen right now, those are the condition codes that are associated with certain prints. So I'm going to actually show you, let's go find there's probably a block print in here. Let me go find a block print. So these are all to be multiplied by 100. So as you can see by the size here. So here we have some good sized trades over here, right? So someone put up, and this all took place, this was at the same second, so 13.4 thousand shares of stock, printed twice at right after the open, okay? And then you look over at the condition code and you see there's a trade through exemption, rule 611. R6 is actually, so R6 is a derivatively priced exemption. So then you say, we are printing through the market, so we're not going to satisfy the best bid and offer, but there's a reason. It's because that security trade is directly related, derivatively priced off of another one, and the two have to go together. So the only way you're actually held is if you're simply trading street side. So for example, if I have a buyer and a seller and I want to trade through the market, I have to satisfy everything that's in, as long as it's not a contingent or a derivatively priced trade or something like that, I have to satisfy all the lit bids and offers all the way through up to the price I trade. But generally speaking, what's lit, that is how many people have their cards turned over and they're saying this is what I want to do and where I want to do it. Mm-hmm. Most people have their cards turned in, which means they're not lit. Turned out means I'm showing my whole hand. All of the stuff that's showing is typically a much smaller amount of volume than what they're not showing. Yeah. Now, the systems do this stuff automatically. So if I'm using Fidessa, which is an institutional order management system, which allows me to trade as principal or allows me to pair off two other institutional market participants, and I say I want to trade 50,000, 5 cents above the prevailing price of Nike, which would be 59.70 as I speak to you right now, it actually will automatically go out and buy with the customer buy side ticket every one of the lit market sales that's out there, and then whatever the number is, it'll print that at 59.70 and it'll put the appropriate modifiers on the ticket. So if I'm trading it as principal, it will say that it's a principal trade. And that way regulators can go back and say, okay, they traded as principal. Was there a commission on that ticket, which is not permitted? for example.
Okay.
So there's a lot of. I mean, we've gone down a little bit of a well here.
That's far more than I think.
Yeah, I mean, look, this is this is the dirty plumbing of the business that people who I mean, I guess this is the thing I would like to leave everybody with, because it is a very deep well indeed to get into the nitty-gritty of trading. I would like to leave you with this, though. Everything leaves footprints on the regulated side of the business. Every text message, every Bloomberg message, every transaction is tracked down to the millisecond. The business is 100, I mean, not 100%, it's 1,000% more fair and closely regulated today than when I got into the business originally in the 1990s. I mean,
Sure.
I'm not going to say it was corrupt, but let's just say that people were still trading on paper tickets at that time.
Yeah.
You know, who's to say what happened when two people are yelling at each other across a crowd? So it is as fair a market as has ever existed for retail market participants.
No, I agree.
Full stop.
Even the
So
transaction costs are so low. You think about before commissions were deregulated, you went to your friendly neighborhood broker, buy 100 shares of IBM, and your commission is $175. Plus, there's a bid offer spread down at the New York Stock Exchange. And now it's like we do that it's paper thin.
Yeah, I mean, these things, stocks can trade in sub-penny increments. Options trade in pennies.
Yeah.
So, I mean, you can actually see this on my screen right here. So this block, this 20,670 share block of stock, traded at 59.4482.
Yeah.
So that's, no, but this was also a trade through exempt trade, as you can see from the condition modifiers over here.
Well, I would add to Tucker D.
Oh, yeah, this is a good point that Tucker D. Dog just made here. Retail sees names like Dartpool and automatically thinks it's nefarious, not just because of the name, but anything they don't have access to must be up to no good. Yeah. Well, the funny thing is that, some of these dark pools, Goldman Sachs doesn't have access to it. And that was the whole idea in the first place, was they were trying to keep. So there were actors who were trading huge blocks of stock that said there are nefarious actors and we're trying to hide from them.
Yeah.
That's what the dark pool was.
Yeah.
They were trying to hide in the dark. So does that mean that, look, the world is filled with bad actors? Some of them are smart. They figure out how to game things.
Yeah.
I'm not going to claim that never happens, but what I will say is that ours are tightly regulated, and a dark pool is not necessarily a bad thing.
Yeah,
I'm not going to say that every one of them is good, because I don't think that they are, and I'm not going to say that every user of them is good, because I don't think that they are. But I will say that they should exist, and it's always a work in process.
Yeah, well, what I tell my students is when they start trading, when they get out of school and they have an income and they start saving, that you do your homework, get a price that you want, use limit orders. And if you get the price that you want, you should be happy and move on.
Yeah, it's, oh, yeah, FinWest. Good morning, Mark. Will you have any students participate in this office hours broadcast, or have they left the building for the summer break? Are there any summer students?
No, they are all gone. They're doing their summer internships now, so none of them are.
Do they have a summer school there or anything like that?
Yeah.
Oh, yeah. Yeah, you're not actually at your office. So
today I'm at home because this is the day that the school is taking off for Juneteenth. Even though it was yesterday, the holiday at the school is today. So.
Is it? So it was a federal holiday yesterday, but it's a school holiday today.
Today, I guess. Yeah, because I take Wyatt. He goes to school at Rutgers. So that was the day they say, this is the day we're taking off. We're not taking off Thursday. I think they wanted to give him a 3-day weekend. So they just said, hey, look.
I get that. I'm all in favor of that, personally.
Yeah.
I think that if you're going to have a holiday, throw it on a Monday or Friday.
Yeah. So.
Why not?
So that was cool. I got, that's great. Um,
CoreWeave. Do you know anything about CoreWeave? We are being asked. So DJ is saying, just joined, not sure what I missed. How would you trade CoreWeave here?
that's not
Do you have?
Corey is not my area of expertise. I think they are network security company.
Yeah, the cloud services and infrastructure,
Yeah, and as I recall,
things
when
like
I
this.
looked at it, they are they making money and they still net build out?
They are so they're. I mean, they're really
They're
rapidly growing revenues, but they are not net income positive yet.
yeah.
So they've had significant negative cash flow. They've taken on some debt to do that, but the forecast is for full year revs of over $5 billion. Which, by the way, let me bring this
Well,
over
that's on
here.
a market cap
That's
of 88 billion.
yeah,
That's
it's not a
quite a
cheap
that
company.
is that you are paying
But take a
for.
look. They're looking. Yeah, I mean, the street right now is expecting year-on-year revenue growth of almost 100%, um, over the period. Oh, let's see. Actually, it's yeah. Look at this. Yeah, it's over 100%. What am I talking about? So, full year revenues last year 1.9 billion. Prior year was, I mean, it was a zero revenue company just 3 years ago. So, um, that is definitely rapid growing. They're looking at 11.5 billion is the street's estimate for revenues for 2026. They're expected to achieve profitability. Let's see when their anticipated profitability is going to come. This is not saying when they will be profitable. This is just I'm looking at what the street's expectations are. So the street's expectation for the first profitable quarter is the last quarter, Q4 of next year, is the first and they're anticipated to do 3.3 plus billion dollars in revenues for Q4 26, which is more than their full year revenues in 24. So this is, a you know, hugely growing business, but it is at a very speculative multiple. My thinking here, and this actually just goes back to, so this is more of a general point I'm going to make about this company and others that are like it. And Mark, I'd like to get your opinion on this. And I only have a few minutes because I actually have a work-related conference call with a big fund manager that begins in just a couple of minutes. That if the Fed did not act, we did not expect them to.
No.
You've expected rates to maybe be persistently higher for persistently longer than a lot of other people had anticipated. That's not a favorable environment for what we call long duration equities, of which I would describe this as one.
Yeah.
That's my opinion. What's yours?
Well, that's certainly the companies that got hit the hardest when rates started to rise, and I think that's right. Ones that are going to have their cash flows, 5 to 10 years out. Those are the long duration guys, and they're going to get hit hard. This company is growing very fast. It's not a space that I understand very well, and I'm not sure why the growth is as fast as it is. 100% growth rates, and there's other people in this space competing as well. This is not like, they don't have a monopoly on anything. They're not like, Nvidia that has the one chip everybody wants. From my personal standpoint, I don't try to trade stocks like this because I don't understand them. I follow Warren Buffett and say, this is not in my circle of competence. And you kind of wish that you did. I did, because if you get these kind of stocks right, you really rake in a lot of cash.
Yeah, I mean, it's interesting. I would just remind folks that Nvidia, which has proven to have technology that everybody very desperately wants for a considerable period of time, you will find windows of opportunity to purchase fast-growing companies that are in areas where we can sort of catch up to speed. I admittedly also don't know what the moat is around their business. That's really the thing, right? So you can forecast a growth curve that's all exciting, but the truth is you also have to make sure that they have a sufficient moat and that the demand side stays up. And that, unfortunately, I don't have a tremendous insight into that. And with that, we have just hit 10:30 local time, which is when my conference call is due to begin.
Okay.
So unfortunately, it is here that I'm going to have to cut this one short. Monday Morning Quarterback, I know that you are flying transcontinental and flying around the world, basically. Safe travels to you, sir. And a great weekend to everybody else, including you, Mark. And, we will see you on Monday, 4:15 Eastern. Tony Zhang will be joining me on Open Interest. Thanks for watching.
All right.